I would like to start by thanking CFS Society Switzerland to give me an opportunity to share my knowledge. Just FYI that I speak a little bit fast, so at any point of time, if you see that the train is running very fast, just stop me, okay? So as he gave the introduction, we specialize in early stage product valuation, and we believe that we learn valuation by doing more of an early stage than the late stage, because there are a lot of challenges, there are a lot of uncertainties. So this is not a class about valuation. This is about all my experiences. What I did was I just encapsulated in this presentation where a lot of questions were asked during the valuation process, some of the mistakes or myths, which I would call rather, and I'm sure I don't say that what we do is 100% perfect. So I'm very open to questions and challenges posed by you, and that way we'll have a good learning process, right? So the whole this talk is built on this kind of 4 or 5 premise, okay? So I'll tell you, when 7 years ago when we decided that valuation should be in our portfolio of services, right? So I was talking with one person. He has worked throughout his life in private equity, and so he was shocked actually when I said that I'm going to put valuation as one of our services. He said, "What are you going to do in valuation? I just do in 2 minutes." So that made me realize that there are many people who still do not understand maybe that there is a value and there is a price. What he was talking about was price, that market is ready to pay you based on multiples, and you of course do in 2 minutes, okay? But what thanks to this particular sector where I do, if I have to value a product, and if you go and talk with the pharmaceutical companies, they would like to understand the fundamental value, okay? So here we are talking about the value of a particular asset, okay, not just the price, okay? So second also important, which I would say is a kind of a myth or something, where many people say, in fact, last year when I was in Stockholm, I met one of the guys. He said, I also do a lot of valuation for, so I said, okay, how do you do that? Oh, I have a nice spreadsheet, and I put all the numbers. So I believe that spreadsheet is just a tool in order to help you to get that, right? But most important thing is, valuation, in my personal opinion, is how do you build up a story, right? Because when you are in the early stage, you have a lot of challenges, you have a lot of uncertainties in the future. So a good valuation should have a good story, and that you need to also convert to numbers in order to, because you could have a fairy tale, right? You can talk about your earnings going very high or taking market share of 60%, 50%, right? But if you tell me that particular story, I really have to make a consistency check in order to understand, if we are consistent or what you're earning is very consistent with what an industry is making or not, right? Second, also, I just copied pasted this line from one of the partners who does a lot of M&A in Basel, where he said that we all know that in DCF you just change one number and the value is very different. No, he's very true. If you use an Excel sheet, if you change many things can change, right? But the important thing is that how are you consistent in your particular assumptions, and we are going to see what are the checks that you can do in order to understand that if you are changing a discount rate or you are changing your market share or something, is it consistent or not? And that is the whole idea of this particular presentation, okay? Last but not least, okay, another one interesting thing that happened was, so in life sciences, it's a long value chain. So the companies start building products. It takes at least 10 years, before the product gets into the market. So I was talking with one guy who was in the last value chain in product commercialization. So he asked me, how can you value an early stage product? Because it's impossible. We do not know what's going to happen in the future. Now, he is absolutely right. Actually, when we try to value, we try to be kind of a god, right? We are trying to forecast and try to make sure that what we predict could be true. But the most important thing here is that our objective is not to be 100% correct. Our objective is that how less wrong we could be in our analysis based on whatever the information we have as of today. Okay. Last one, I recently just a week ago. Which we are about to value a very young product. and the management team comprises from scientific background, and he mentioned, so what could happen if I hire a CEO right now? Would the value change? What do you think? Should the value change? So let me, when we try to value a product or try to value a company, okay, it is implicit in the assumption that the management team has the capability to do the things that he is required to do that. To put it clear, if I'm valuing a product, early stage biotech product, which is supposed to be licensed to a pharmaceutical company, right? It is implicit in the assumption that the management team has the capability to launch, he has the capability to understand what should be the price in the market and so on, right? So I personally think that in the status quo valuation, that those assumptions are already implicit. But yes, if you can tell me, for example, there is a young company, for example, Twitter right now, right? The Twitter has been making in news for many wrong reasons, for many things which are happening not very right in the sense of their earnings, profits, and so on. Now imagine if you tell me that, yes, instead of the current CEO, if I hire Mark Zuckerberg, for example, how would my value change? Now he has been very successful in taking the Facebook to very high market cap today, very high value. So then you could argue that, if he is there, what could happen to the market share of, he can find out new ways to earn revenues, he can find out, he can increase the operating earnings for the particular company and so on. And then you can justify. So the point what I was trying to make here is that, these things are already implicit, and I don't think we need to make any changes to do that, right? So now I'm jumping on one particular case study. So what we did was one of the companies asked us to revalue one valuation which was already done by an iBanking, from Madrid, okay? So the product was a kind of a diagnostic company, and they already have CE mark. They were about to launch the product in the market, okay? And there are a lot of assumptions being used, as usual in evaluation process, okay? So what we saw that during this early stage, a discount rate of 30% was used for 10 years, okay? Now let me ask you. So it's a 10-year period, for example, okay? The product is about to be launched. It has a patent life of 10 years, okay? And you are using a discount rate of 30%. What's wrong in that? Is there anything wrong, or do you think that, it's okay to use, because it's an early stage company? So let me answer. Silence means either you're not getting me, or maybe I'm boring you, right? So 30%. Okay. First of all, it is very important to understand that, first of all, many people do not understand that the discount rate also should be in the same currency in which you are valuing your company or assets. So your cash flows, if they are in euros, your discount rate has to be in euros. So, but if you see that there are a lot of rule of thumb going around, so last week when I was trying to assist one company in checking the valuation, so this company was launching product in Mexico, okay? And he was using a discount rate of 7%. Okay. So first of all, I asked him, which currency are you doing? So he was confused. What do you mean? What do you mean by which currency? So I said that, okay, first of all, what's your cash flow? In which currency you're analyzing your cash flow? Okay. Oh, it's in euros. Okay, fair enough. So tell me, if you launch your product in Mexico, and if you launch your product here in Europe, are there any different risks that you have? Of course. Mexico is more risky. You have social risk, political risk, economic risk, right? So how can you use the same discount rate, for example, for using that? So that's the first point what I'm trying to make here. Second point, we know that in the real world, the risk is dynamic, right? When I say dynamic, today, if you are a risky firm, but if you are successful 5 years down the line, you are less risky. That means I cannot keep the same discount rate for 10 years. Point number two. Now you will say me, oh, wow, that's fantastic. I can change my discount rate, but how do I change my discount rate? We make an assumption that, okay, if in 10 years, if you are successful, you should behave, you are in a steady state, you should behave as what other companies in publicly listed, let's say small cap, how they are behaving, and what's their discount rate the investors are demanding in the market. So let's say I start with 30%. After 10 years, I know the discount rate, which is, let's say, 10%, for example, in US dollars. And then I want to converge that. How do I converge that? You might ask me how faster it's going to be less risky. It depends on your analysis. You can say that, oh, the company has great products, it's going to be less risky faster. So I can converge to 10% faster. Okay, maybe in 3 years, in 4 years, right? Third point, especially in industries such as biotech or mining or oil and gas, right? There are a lot of discrete risk. So what I'm talking about is, in biotech, for example, you have to cross phase 1. If you're successful, you have to cross phase 2, and so on. Okay. Then what we do is that, in order to understand that risk, we try to understand, okay, what is the probability, that you are going to cross this particular phase. Okay. This can be done by a lot of scientific study already being done, talking with experts, and so on. That particular case, in the case of biotech, even oil and gas, for example, that particular probability is already included in that cash flows. So if somebody asks you that, okay, I'm going to use a discount rate of 40%, the next question should be, okay, what currency? Okay. Second, what kind of risk are you talking about? Oh, it's going to fail, for example. Yes, but that risk is already encapsulated in the cash flows. Why you want to push up the discount rate very high? You're double counting the risk, right? Now you might ask me that, okay, I started with, let's say, 30% and I landed at 10%. Isn't it a fairy tale? What needs to happen for the company to reach that particular stage? The company has to survive, right? There could be certain risks which are not clinical, for example, but it could be because the company is not able to raise money, for example, or the management could leave. There are certain risks. The company needs to survive. That risk of failure can be attached at the end. So imagine you use the particular value. You got, let's say, for example, 100 million. Now I'm going to ask you, okay, what is the probability that the company can survive or fail? If the probability of failure is 40%, okay, and there is no liquidation value, my value today would be 60% of that 100 million if I have got it. Does it make sense? So discount rate is actually meant to capture continuous risk. It's not meant to capture discrete risk. So it's always better to understand what kind of risk we are talking about and make it a separation in order to move on, right? So another important part which I want to talk about is about the 30%, okay? So how do you actually, should you really get into academic, calculation of, CAPM risk-free rate plus beta multiplied by risk premium and so on, or you try to understand, what market is trying to kind of get the return, for the kind of the companies you are valuing. So what we actually do is, I would like to show one data. Okay, the source is from Damodaran. If you see based on what industry you work, okay, if I talk about the biotech companies, the highest cost of capital in US dollars is 10.29%. And I'm talking about very risky companies. It's a publicly listed, it's 10.29% in US dollars, okay. Now, if I have to value a company in euros, of course I have to, based on expected inflation in US and euro, I can convert that discount rate into euros, okay. So let's say for one company which I was valuing last week, so we did that, okay, the riskiest company here is 10.29%. You can also have the data, you can also check in euros, for example, all the companies in Europe, what is the, you can take the higher decile of that particular discount rates, okay. And then you can make an assumption that, okay, this company which I'm valuing is kind of a very young company, okay. This is also one of the, discount rate of a riskiest firm. 10% is still slightly low. Why can we can put 14% or 15%, which is also the higher decile of, one of the European I don't have the data to prove, but you can see that the higher decile in some of the European companies is around 14 or 15%. So I started with 15%. Now you could argue me that, okay, this is a publicly listed company. You are a private company. So I give you full freedom to use your illiquidity discounts and all that in order to do all the adjustments that you want to do that for the company, okay. Any questions till now? Okay. That means you're either understanding everything or not understanding everything. Okay. Okay. So let's talk about one interesting question as well. Okay. So what happened was one of the partners of an M&A firm. I met him in a conference, and he said, as he knows that we specialize in valuation, so he said, I would like to talk to you, and I need one help in getting discount rate. I said, okay, what's the big deal in discount rates? So he said, is it private firm? He said, no, it's a publicly listed. I said, then what's the problem? So no, actually, you know what? The risk-free rate is very low. Okay. So what I did was I took the normalized risk-free rate, for example. I said, hold on. First of all, we perceive risk-free rate, as an opportunity cost, right? Imagine today if you don't want to take any risk and you want to invest in German bond, how much you get it today? 0.3%, right? If you normalize and get 5%, that you will get it in a nice spreadsheet, but you are not going to get it in the real world, right? That's point number one, okay? Now, if the risk rate is really low, what are the implications? So he said, yeah, you're right, but if I use, 0.3% risk-free rate, my value will be very high because my discount rate will again decrease. Now, the point here is, he was missing few things. One of the important thing is that, as we talk about, the world is dynamic. It's not static. So in the implied, let's say if you talk about 10 years, the market return in US dollars, you will see that the market is giving on an average implied equity risk premium of around 8%. Okay, what does that mean? It means that if your risk-free rate is very low, the risk premium that you're getting is going to increase. That's point number one. Second, let's get back to CFA level 2. Those guys who might have done, long years, it's a kind of a revision. Fisher equation in economics, right? When we say that, okay, risk-free rate is equal to expected inflation plus, expected real interest rate, right? Which is kind of proxy for GDP growth of the economy. If your real risk-free rate is very low as of today, the growth that you're trying to project for the company also has to be low in order to be consistent. Now, you might argue that the market is wrong. That's true. It could be. Okay. So that also has to show somewhere in the growth prospect when you're trying to forecast. Third point, if the interest rate is very low, what does the company do? They also take a lot of debt, right? So if they take a lot of debt, then what happens to the debt to equity ratio? It's also going to increase, right? There is also, I don't have the data to prove that, if the risk-free rate is also very low, the default spreads on the cost of debt also goes high. Okay, what happens to the cost of debt? It slightly moves up. So what I'm trying to say here is that it's not that easy, right? So you cannot say that, okay, just because one thing is changing, everything remains static. No, it's dynamic, so we have to keep changing, and that's how you have to incorporate all these things in your valuation. Okay. And of course, as I talked about, some of the mistakes which I saw was, let's say you calculate free cash flow to the firm and then you discount it with cost of equity. So these are small things, that you, yeah.
I disagree with, or I wonder whether I got your point right about the low risk, real risk rate. You're saying that there's little growth, so the company should also, or the valuation should also imply low growth. But is that what you said?
Yeah, so the real risk-free rate, for example, is a proxy for the GDP growth of the economy. Okay? Yeah. So if that economy is not going very well, for example, then you really have to justify why you are growing, super high at this particular moment.
Sure. Well, we're talking early stage valuation of companies who are promising to be growing really rapidly, either by creating a new market or by taking away market share from other companies.
Right.
So how does macro and micro match? I'd argue that they don't necessarily.
Sure, for example, for early stage products, you're right, because my early stage product is going to be launched in 10 years down the line. Okay, so of course my forecasting, at that point of time may not need to include, for example, this. But if you're trying to, it's a general statement, that if you're trying to value a company right now, for example, who already has revenues and everything, so that growth has to slow down right now. Right? So that's what I meant. I don't know if I answered your question. For early stage companies, if your growth in revenues and operating earnings are coming, let's say, after 5 years down the line, of course you may not have to make that particular assumptions about it. But if you are already earning revenues right now, already earning operating earnings right now, then that has to impact somewhere, because if the economy is not doing well, then you really need to have certain great products for the consumer to buy it, and that has to be so the point of what I'm trying to make is that it's not a set of 100% rule, but it's just a consistency check to understand that, okay, if the economy is not doing well, but my company is doing very well, for example, growth is very high, what's the reason? If I can make a story and justify, fantastic. Yeah, thanks. And last, is discount a really big deal? As I talked about in this particular slide, right? You can say you can check that most of the publicly listed firm, the discount rate ranges from 7% to 14% or 13%. So what I'm trying to say here is that I see many people confused with the discount rates. I don't think it's a big deal. I think you make the right assumptions, right currency, and then you move on with the discount rates. Okay. Now, as I said, one of the guy who works in the late stage in the product commercialization, he asked me how you can value early stage companies, right? So I think in early stage versus matured stage. In matured stage, when the companies are already having a lot of revenues, you have a lot of historical data. So you really have a lot of things to say about it. But in early stage valuation, you really have to build up a story, and that has to be converted to numbers, okay? That story also depends on what kind of audience you're talking about it, okay? Let me give you step-by-step an example, okay? I think you might have heard about this company. Of course, I'm giving this example because I work in this industry. The company called Theranos. Have you heard about it? So you might have heard about how the Elizabeth, I think she was a Stanford dropout, and how her board of directors had people like Henry Kissinger, 92 years old, and so on. And of course, she was also known for, like, Steve Jobs, turtlenecks, so she was going to be, the VC industry, I think, gave her one of the top positions, I think one of the most innovative firms, and so on, okay? And later, I think the Wall Street Journal broke out a story which said that the technology that she's trying to claim, okay, is not working that very well. And even FDA had some particular problems. But what I'm trying to say here is that the story that she built at that point of time, she had a very fantastic board. I wouldn't say that the board was very good at executing, because it's a biotech firm, and there are a lot of people from military in the board of directors, for example. So unless and until you're trying to create something secret for military, I don't know. I don't have any idea, so I don't want to comment on that. But if you see the board, corporate governance, you might see that a lot of people who were not from that particular industry. Rather, they were from very different backgrounds in that. So the idea here is that you have to build a story. How? So for example, if we do product valuation, the first question we ask is it possible or not? We sit down with of course, the experts in that particular area and say that, is it possible or not? Sometimes you get an answer, it's impossible, okay? Fair enough, that's a good answer, it makes our life very easy. But sometimes the answer is, yes, it's possible, but I'm not sure, but there could be, it's a possible that they can come out with a new product in a different indication, such as cancer or, some other indications, okay? In that particular sense, when you have huge uncertainty at that point of time, then one of the best way that works is the options. Okay, real options that we use it in order to do that, but we don't do it for each and every product. I'm going to talk about when we try to use real options. Okay. The next question that you ask is it reasonable or not? So, for example, I'll give you. Have you used BlaBlaCar for car sharing? It's a BlaBlaCar. Okay, I have used it here to come from Basel to Zurich. It's €5, fantastic. I'll tell you. So it's a car sharing platform. Okay. Now imagine BlaBlaCar tells you. So basically, the business model is that you see who all are coming from Basel to Zurich, or Zurich to whatever, in the morning time, and it's a car sharing kind of platform. Okay, so you can book it, the driver, you have a track record, and so on. Okay, so if BlaBlaCar tells you that, okay, right now we are doing from Basel to Zurich, but I think we have an option to kind of little bit expand into suburban market as well. Okay, then that makes sense. Then in that particular valuation, I might try to kind of increase the growth rate, for example, because they are getting into a kind of a new market. They might open a new market, for example. And last but not least is, of course, how probabilities. We really have good data and all that for doing that. Then, of course, thereon we use the DCF, where you have at least some enough information in order to start with. Okay. So what I'm trying to say here is that the narratives matter a lot in valuation, especially in the early stage, and you also have to be very careful to whom you are trying to present. So, for example, when you talk about this Ben Graham's book, right, where they said that they believe on dividend discount models, and where they used to invest in the companies who give a lot of dividends, right? So if you try to, let's say, kind of present a story. Let's say you go to Omaha and present to Berkshire Hathaway, maybe that audience is not the right audience to tell that particular story. Your story might be interesting for those investors who are at early stage, or they are the growth investors who think that there are huge potential for that particular growth. So if I talk about Facebook, for example, what is the market cap right now for Facebook? Maybe I don't know, 150 billion or something like that. I'm not sure, But right now, for example, based on the revenues that they have and the potential that they have, one of the biggest thing for the Facebook is right now the optionality embedded with having 1 billion subscribers. So you have an option that, this guy, Mark Zuckerberg, can open another new market, and they already have 1 billion subscribers, so he has an option to monetize, right? So if I have to value Facebook, for example, I also will try to see what are the other markets he's going to increase. And if I'm a growth investor, I might be willing to invest here because I think that there is a huge opportunity for growth. Whereas if you try to present it to late stage investors who are more interested in investing in mature type of companies, they may not be interested in buying you that particular story. And that's the reason I think Warren Buffett never used to buy in technology. I think he recently started by buying Apple, but he says that he doesn't understand technology, and that's one of the reasons, what kind of audience you're talking about. Okay. So this was the graph I'm just trying to show you to tell you that one of the valuation where the investment bank had done for this early stage company had this growth of this cash flow, free cash flows, and this is our cash flow. So the CEO asked me that, how do you give me so much of wide difference, So instead of telling him in numbers, I decided to tell him a story. I told him that, listen, you decided to launch the product yourself. If you want to launch your product yourself, life is not easy. You have to set up plans. You have to set up, some labs in order to do that. There is a huge capex involved in that. You have to set up your own sales and marketing team. That's a huge expense. So initially, your free cash flows has to be negative, right? And it has to negative, and slowly it might, move up based on when you start earning a lot of revenues or earnings, for example. So the point what I'm trying to make here is, in early stage valuation, you have to understand, you have to build up a story. Without story, I think if you tell only a story but you do not give you the numbers, that's also very inconsistent, because what happens is that you can tell a fairy tale story. You can tell a lot about this particular company and great products, because when you meet with a young entrepreneur, of course he is very enthusiastic about his product. In many of the analysis, he thinks that he's going to conquer the world, which is fantastic. But then you also, if you are able to bring those numbers into the picture, you will then realize that pull him down to the earth, I think you're not consistent. And I'll give you some of the examples how it is not consistent. In some of the examples, if you see, you will see that, first of all, you cannot capture 100% of your market share, right? So the point what happens that when you rely on Excel sheet and you keep moving up the growth, you come to a particular stage in year 10 or 15 or whatever you see, you try to see how much market, you also see what's market, how it is growing, and then try to see how much market share he has in year 10. I was surprised to find that in some of the year 10, it was 200%. How can it be? If your market is, you cannot have more than 100% of your market share, right? Another inconsistency we talk about is 100% of the profit margins, or the profit margins being very positive. So I get a lot of requests saying that recently I was analyzing one company and I saw that he was looking to raise $10 million US dollars. Okay, fair enough. In that 10 million US dollars, he was having a positive earning right from next year. Okay, and slowly he already had 15 million of, let's say, positive earning in year 4 or something, 5 something. I said that if you really have so much of profits coming, why do you really want to raise 10 million, right? No, but if I show this to investors, then I will have, the negative earnings do not look well. I said, investors understand you that, this is an industry where you have to invest a lot of money on R&D expenses. Your earnings has to be negative in the beginning, and slowly it has to move up. So it's okay. But the point what I'm trying to bring here is a lot of entrepreneurs, when they want to project the cash flow, they want to be in the positive line than in the negative line. But having a negative is not a bad story. It's okay. It's very practical and understandable that you will have a negative, earnings in the beginning, and slowly you are going to be positive. Okay. I talked already about this particular risk, right? What kind of risk we talked about in finance? I think we already know all about market risk and firm-specific risk, right? I think one of the important things which I talked about was discrete versus continuous, in which how a lot of companies, even I think a lot of even private investors, they push the discount rate to 50% and 60%. And my questions to them is, what kind of risk are you talking about? In discount rate, you can capture continuous risk, not the discrete risk. You can bring the discrete risk out of that and use it at the end of the particular analysis, or you could also use probabilities in order to do that. Estimation versus economic, it's just a very simple risk which I talk about. Estimation risk is like, you kind of, you're analyzing a market or a product, and you don't do it enough due diligence in order to capture that. So that analysis will have certain risk that your analysis is not very right. And economic risk are something which is dependent on the economy, which you cannot do much about it. Okay, so these are the risks that we talked about. So, for example, what risk matter of the Volkswagen diesel scandal, right? So you really have to understand that if you are trying to value a company, there are some risks. Does it really change the fundamental value of the company? Do you really think that Volkswagen today has, huge, it's going to close down? The answer is no. It's a discrete risk, and you can bring that, in the discrete steps, rather than increasing the discount rate of Volkswagen just because they had a diesel scandal.
Electrification.
What do you mean by that?
Yesterday we had a headline that Volvo is phasing out fossil fuel cars in 2 years. Okay. So that you're talking about getting into a different kind of market. I don't think discount rate has anything to do with that particular thing. Where you can talk about that. Okay, if the market is getting different, is Volkswagen is going to be into the new market? It's trying to capture that new market or not, and that you can build it in the cash flows, right? And the last important thing, before, okay, I have 2 slides more, so we are here. So when we are done with the valuation, it is very important to do a consistency check. And what I could talk about it, consistency check. If the company is very risky, okay, if you are making a lot of reinvestment into the company, and if you are having a very high growth, the story looks nice. High risk, you are investing a lot back into the company in the terms of R&D expenses or technology and all that, right? And you're having a high growth. So it looks very consistent. But you might have, some of this when you say that, okay, it's a high risk company, very high growth, but there is absolutely no reinvestment in terms of capital expenditures and so on. There is a red flag. You really have to stop and see, is it really true? Can it happen in this particular industry? Is it like the guy has, really come out with something without any much of investment and he's going to earn a lot of earnings in the future? If that happens, then you can prove it right, but otherwise you have to, make a stop. Similarly, if it's a low risk game, okay, lower investment, if it's a very high growth, then really you have to justify. So, we can, use these tools in order to kind of do a consistency check. And that is what, when I started the presentation, and I talked about that, many people say that, oh, if I change something in the Excel sheet, my value changes a lot. Very true. But I think if you have these particular tools in your mind, you will be able to understand, what are the things that is changing in the future and how you can control and if that is consistent or not.
That brings me to just 2 slides that I'm going to talk about options, right? I said to you, mentioned that, when we try to value a particular product or company, for example, you try to think about that, is it possible or not, right? If it is impossible, forget it. The value is 0. You don't have to do anything. But if there is certain possibility, right, then the optionality comes into the play. So what is real options? It's like the financial options, right? It gives you the right, but not the obligation to kind of invest or make an investment in the future, right? So here, for example, I just put this particular graph, which I took it from HBR, So the options work very well when you have a lot of uncertainty, and your decisions, can make an impact in the future. And in industry, you will have certain decisions that the CEO can make that might help you to make a kind of an impact in the future. If the impact is very low, it doesn't matter. You don't need to do value using options. Second, if you are valuing that particular possibility and your NPV is already very high, okay, let's say 300 million or 500 million or 1 billion, I'm just inventing, then also the optionality doesn't make sense. Why? Because when you really have a lot of information on that particular product or product market, for example, right, then you really have you don't have that much of uncertainty, and you can play around with your own decision with the information that is available in the market. Okay, but when you have a lot of uncertainty, then you might make certain decisions that might help the product to kind of get a huge market share and so on. To be explicit, let me tell you when we apply real options. First of all, it is very important to understand that you need to have a certain exclusivity. So for example, if I talk about, for example, several cancer drugs where there is no cure, right? If there is no cure, for example, then what could happen? One option is that the product could fail, in the future. Fair enough. So what happens in the options? You have the right but not the obligation. So if it fails, you don't make a lot of investment, right? You just make an investment as an option fee, for example, right? But if it succeeds, your return can be very, very high, right? So you use options only when you see that, first of all, you have a lot of exclusivity on that particular market, right? For example, if you want to go to and expand to, for example, emerging markets, right? These topics are very hot, right? You want to expand in China or India, for example. So if you want to, let's say, expand in China, and you tell me that there is a huge optionality there, I have an option to expand, okay, which is true, right? But your competitors are not sitting out quietly there, right? So if it could happen that the government of China or India has a special relations with you and tell you that I give you an exclusivity for 3 years, then at that point of time, valuing using options makes sense. So I'll give you some of the examples, okay, just to try to help you understand. So one of the CFO of a big Indian pharmaceutical company, he knows me well. So he gave me a call one day and he said, you know what, I have done DCF valuation for my product. Now I want to do with real options. One of the confusion that many people have is DCF is different and real option is completely different. Methodology is of course different, but the most important thing is that when you value using real options, the value of the underlying asset is calculated by present value of the assets. What does that mean? That means that the NPV or the present value, if your DCF is wrong, the value of the underlying asset will be wrong, right? And then options give you a kind of a premium that you attach on the top of that particular present value to tell that, okay, this is my value from the option, this is the value that I got from present value of underlying assets, and this is my total value. So these two are complementary, they are not mutually exclusive, right? So to say that, okay, I have done by DCF, first of all, the question you should ask is that, should you value by options? Do you have really exclusivity on that particular product? Is it so early stage that there are a lot of uncertainty and the decisions that you are going to make is going to impact? If you don't have answers to these particular questions, it's better if we don't do that. Last point before we leave is it important? Why do we really need to value that flexibility that we have using options? We have other tools as well, like decision trees. So we can also use decision trees in order to capture the value of that particular flexibility that you might have in, let's say, imagine you invested in this particular product and you know that after phase 1, it might fail, it might succeed, right? So you can capture that also using decision trees. The real option purist, I attended one conference in real options, which was organized by a professor called Lenos. He's considered kind of a real options guru. So when you go there, the life is full of options. Everything is options, actually, okay? So even when I came from Barcelona to Athens, there was an option, that I had an option to come here, But the point is that not all options have value, right? So why do you spend so much time and energy on getting all these binomial, trees and all that in order to get it, right? Let's be practical, actually, okay? And that is also one of the reasons, because of the complexities of real options. I think, in pharmaceutical industry, maybe 5 to 10%, is used in the real options are being used. Mostly they rely on net present value or decision trees. And one of the benefits that real option purists argue is that in real options, you use risk-free rate to discount, right? Do you know why we use risk-free rate in real options? Why not discount rate? Because in real options, you have an option but not an obligation to do that. If you consider the investment very risky and if you see that the value is negative, you don't exercise the option, right? That's the reason we use risk-free rate in real options. So they argue that, the discount rate is very confusing, it's very subjective, so that's why it's better we use risk-free rate. But they also have to understand that real option is very complex, and sometimes, especially in our industry, it's an option on an option on an option, which is a compound option. That makes the life very complex, yes.
A question about these options. I mean, you look at Facebook or Google, you look at these companies. I mean, the founders themselves, they had no clue in the beginning how the thing would develop.
Yeah.
So the options they have today, 10 or 20 years back, nobody would actually understand or look at. So is that also something, those options that you have, particularly in certain sectors and others, you just don't know because the markets, you don't know how the market will run?
No, that's true. That's because, see, what happens is that when you start a company initially, right? For example, when Mark might have started, today I'm sure he might have realized that he could not be here what he is today, actually, all right? So, but as and when you do business, you at least get an idea that, okay, how you can monetize it, right? So today, for example, there is a company in Spain called Wallapop. I'm not sure if you heard about it. So in Wallapop gives you a platform, okay, to sell used products. So you want to sell, let's say your used mobile, you put the price, and there is no charge. It's free. So you go there, you give whatever 200 euros, and I don't know how it is viable in terms of tax and all that. I don't know, but that's how it works. And they have, I think, 2-3 million subscribers right now, for example. So now, the investor's mindset is that, okay, now I have 3 million subscribers. I think now this is the right time that they can monetize in a different way, right? So now it gets into the optionality. I think it's a matter of an experience. In many business, you really do not know. And that is why I said that, you have to sit with the experts and understand, is it possible? At this point of time with the information, if it is not possible, I don't get into options and complicate my life, right?
The second thing is also the CEO, which in the beginning, I mean, they say that different phases of CEOs, right? You have the guy who starts and the guy who leads. And Mark Zuckerberg, well, those kind of guys are maybe exceptionally, but in general, you don't have the guy sitting actually over 10 or 20 years at the top. It's also different because you have to see actually the potential of this guy who does that, if he's really ready to do that. I don't know how you calculate it. I guess it's quite...
No, okay. Okay, it depends on industry to industry. In this particular industry, you license out after 4 or 5 years to big pharmaceutical companies, right? Because you don't have the capacity to do that. It's very clear, okay? But if you talk about the very normal kind of business, the track record of that particular person gives you a sense, actually. If he's the first time an entrepreneur, for example, when we value, we don't consider that every company will become Facebook. We have to be, very conservative. It might be a possibility that, it can become. But the point is that, as we said, it is very difficult that you cannot be 100% correct. I think based on as and when you get the information, you try to change the value. And if there is you have to understand that if whatever the event that happens in the future, does it really change the fundamental value, or it is just a kind of, a temporary phase that the company is going. And that's how you try to incorporate that in that particular value.
Let me ask you this last question.
Yeah, sure.
You're specialized in pharma. Do you think the guys who value experts, like you are in pharmaceuticals or biotechnology, does that need to be like for sector, or can you, for example, find value a finance company or tech company?
See, in my opinion, valuation is sector agnostic, okay, because the fundamentals, kind of work in each and every sector. But in order to do that, for example, you need to know the market, because if you do not know the market very well in industry, you make mistakes, in your cash flows, right? So that's very important. Open to questions. I'm done actually.
So